Welcome to Global Money Talk, brought to you by Sompro TV. Greetings to all of our viewers from across the United States, Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Tai Wong, and joining us today is Mark Newton, Head of Technical Strategy at Fundstrat Global Advisors. Mark, thank you so much for coming on the show.
It's my pleasure. Thanks for having me.
Well, it's a really exciting time. A lot to talk about today. First thing I want to start with is 6 months ago you said that this is the year, a year for risk taking, and you hit it on the nose. It's been a great year. So I guess my first question is, what is the outlook, going forward now, next couple months until the inauguration, and then perhaps the first part of 2025?
Look, it's been an amazing year. It's honestly been the best election year in over 40 years, which is incredible. Election years typically tend to be quite bullish, as well as pre-election years. We're heading into a year that has a potential of not being as good as this year, and it's important to recognize that normally the first and second years of an administration can be not as robust in terms of returns. There are a few things that have cropped up that are actually a little bit of a technical problem. We have seen some breadth deterioration of late that I think needs to be addressed. Like, technology honestly has not really participated to the extent we'd like to see really since the month of July. And so we've seen many popular breadth gauges start to pull back. Look, the market is in a seasonally good time of year. Usually November, December are some of the best times of the year, but we've already rallied about 15% off the August lows in about 15 weeks, so about 1% a week. We rallied August, September, and October without really skipping a beat. So a lot of those gains are already in the market, and we started to show a little bit of evidence of slowing down of late. So the real question is, can tech participate and help get us there between now and year end, or do we need some consolidation that might happen in the early part of December? The bigger picture, though, is that the market is still intermediate term in very good shape. And heading into 2025, I do anticipate that we'll see, further gains. We should be able to push up to hopefully levels right near 66.50 or so, which would be about a 12 to 15% gain from here. I think the first part of the year has the potential of being much stronger than the second half. And so that's just based on my own cycles that I look at.
So perhaps a 10% gain, 66.50 in the first half, and then a second half, maybe some consolidation.
I do suspect we'll get consolidation. Some of these cycles, made popular by Edward Dewey going back over the last 100 years, have been actually quite bullish and pretty important when looking at market cycles. And one is just the 41-month cycle that governs stocks. And so historically, when you look at patterns, it had a great bottom back in 2022, and we've risen now for the last couple of years, and now it's showing evidence potentially of peaking out sometime mid-2025. So I think investors, are still in good shape. We have lots of great sector participation out of areas like financials and industrials that have come to life, and hopefully on the promise of deregulation and more tax-friendly policy. But at the same time, we all have to wonder about the impact of tariffs and what that's going to do for the economy and really the global landscape with the ongoing wars and how this will all come into shape. So there's a lot to worry about. Normally that's a good sign for investors, but for the time being it's right to sort of stay the course if you have an intermediate term time frame.
So we've had this Trump trade that surged and then sort of backed off a little bit. How do you feel about that? The Trump trade, generally?
Well, it's interesting. You hear the media sometimes begin to talk about a narrative that becomes consensus, like a Trump trade, when you talk about tariffs. And I think it's a little bit short-sighted, and it doesn't consider the extent to which this fragile Chinese recovery likely will set to counterbalance that. It actually could be quite deflationary, as well as the fact that general AI technology bias is also pretty deflationary also as well. And on a third point, we know that the U.S. is set to almost double our oil production. We're already pumping about 13.5 million barrels of oil a day, and that's almost at a new record. And so that's going up and up. And I think as the supply of crude gets higher, that's going to put substantial downward pressure on crude oil between now and the middle part of next year. So if crude falls and the Chinese recovery proves to be somewhat feeble, that certainly will fight our inflation battle for us and help inflation to fall even faster. So for those that are saying interest rates are rising because of potential tariffs, I would argue some of that is just due to economic strength. It's actually gotten, signs, it's gotten much better in recent months. We've seen evidence of recovery. The dollar and yields are going up for that reason. I sense that they're actually going to roll over and start to pull back in the months to come. But the trend in the dollar still seems quite strong. If there's any takeaway from potential Trump policy, it's really that the U.S. should be one of the better places in the world for investing. A lot of these Mag 7 companies, which have all changed our lives for the better, still doing quite well. And unfortunately, that means that emerging markets likely are not going to be as good of an investment, I think, for 2025.
So in terms of the dollar, and I guess we could use the euro as a proxy,
Yep.
or the dollar index, whichever you think might be better. Do you look at it in terms of also a strong first half and then maybe petering off a little bit in the second half of 2025?
I think that's right. I mean, the dollar is heading into a very weak period of seasonality coming into December. It's one of the worst months going back over the last 20 years for the U.S. dollar. And so we've had a big run. The dollar is up to the highest level now. If you look at DXY since October of last year, facing some resistance. We hear now that the weakness of the yen potentially could give the BOJ room to hike. So there are reasons why the yen potentially could rally as well, and that's important. But the euro, has that same seasonality, but inverse, and normally can show gains, in the month of December. So I sense that we're in for a small decline in December into the new year, and then we likely reassert an upward trend in the dollar that can take us higher into likely sometime next summer.
Question, moving a little bit into commodities, and you just mentioned oil that you think could potentially, we're pumping so much that we could be in a downtrend with the occasional spikes. How about gold? Gold's had a phenomenal year,
Yep.
bit of a drawdown, and it's now coming back quite strongly. And thoughts on that?
I love precious metals. I think that's really the place to be heading into 2025. I see this recent pullback is starting to stabilize and turn higher for gold. I think gold is more attractive than silver. Silver obviously is tied to potentially that Chinese recovery, and so gold is really preferred over silver. I think gold moves back to new all-time highs, likely into year-end. And even after consolidation, I think it should outperform and do well in 2025. Historically, times when the Fed starts to cut rates are great for gold. And so I think that that's one place for investors that are getting potentially skittish about technology, you might want to turn. I think gold is an excellent choice there.
Now, in terms of, do you have any sense on? I think this is very China sensitive, but base metals, particularly copper, looked like it was going to rally through 10,000 quite aggressively, and then it's had a very disappointing consolidation. Any thoughts on copper and on the base metals and sort of in general?
I do think it's proper to look at China with regards to copper. Copper had a very good move as China was rallying, as the FXI and Chinese equities, and recently that started to pull back. So I sense that we could be on the verge of making a minor bounce into next year, but if the dollar is going to be strong, that's likely going to put downward pressure on many commodities, and I think unfortunately copper is very heavily tied to China, and really a lot is going to depend on their ability to be able to help their economy stabilize in their own housing market. They're doing their best to try to help I think homeowners, but their own M1, their money supply has gone down substantially, and just the commercial real estate we know is a big issue for China. So very important with tariffs, potentially approaching. That's also really a known unknown in terms of what could affect the Chinese market, and for that reason, I'm a little more neutral at best on copper. I think it's probably going to have a difficult year in 2025.
Probably easier things to trade than copper, it feels like. One thing I do want to get to is certainly the bond market, and having been in the market for a long time, I always felt that all the disasters can help, starts and ends with the bond market actually.
Right.
So in terms, we have some uncertainty in terms of how much the Fed is going to, excuse me, be able to cut, and yields have backed up quite substantially over the past weeks to months. How are you feeling about the yields in general, or any specific parts of the yield curve that you think could be primed for a move that may be a little unexpected?
Yeah, that's a great question. Look, my own feeling is that yields should head down starting next spring, really for the majority of 2025. So I do like Treasuries. I think part of that could come from eventual signs of economic weakness. I think a lot of the Fed's hikes, in recent years really haven't filtered into the U.S. economy yet. It's been a very unusual post-COVID recovery where we still have this work-from-home mentality. A lot of the U.S. investors have locked in at very low interest rates, and now that's affected the housing market. Yields have risen pretty sharply, mortgage rates have risen, and housing is unaffordable. So we know that hiring has slowed down a little bit, but the economy still seems pretty strong outside of just a little bit of weakness on the fringes. But my own cycles for yields say that we have an initial rollover which likely lasts about a month, and then we start to push up again into February, March of next year, where I don't sense that the yields will get back over 5% on the 10-year, but then my own studies say that we're likely going to start to turn down. So my thinking is that could be a sign of economic weakness starting in the latter part of 2025 that causes that downward pressure on yields. Let's not forget, we did see almost a 40-year bond bull market that was finally broken with that big move in yields that happened a couple of years ago. And so I think that the long-term direction for yields should be higher as we start to normalize, but I sense that over the next 12 months, we likely could be in store for further downward pressure on yields.
You make a very good point. A 40-year bond market, there's nobody in the markets now who remembers, a long, a systemic bear bond market.
Right.
Where it's going to rally, and if you say that, as you say that, ultimately, if yields have to turn eventually higher a year from now, wherever, I think that's going to be it'll teach a new generation of traders something a little bit different. Now, I do want to get to something that's been moving sharply, and could I get graphic one? And this is Bitcoin.
Okay.
So here is a one-year candlestick chart of Bitcoin. I actually was from TradingView, and I remember earlier in the year I mapped the downtrend, and then I mapped an uptrend. Yep. And this explosion,
right?
I may have hit 100,000 in time that we've been sitting here. What do you make of this chart? I don't know what to make of it.
Well, look, historically, cryptocurrencies have had a tendency to move in these little spurts where it goes sideways for a lengthy period of time, and then they break out and they make the majority of the year's gains in a period of a few months, and then they go into another sort of sideways cocoon. And so, it is important to recognize what the current trends are, what the cycles are for cryptocurrencies, and really what the sentiment is. I tend to be a little bit more cautionary here on entering new positions in cryptocurrencies. And for the record, I do own cryptocurrencies, but I think that we are going to peak out sometime in the middle part of December, and at the first quarter actually could be a time of consolidation for the entire crypto space, which will be a disappointment to many people, but that's within an ongoing uptrend. Keep in mind we've almost doubled just in the last few months. Bitcoin has been up, I think it hit 15,000 in 2022, and now we're close to 100. So it's been a historic run just in the last few years. But these kind of movements, they don't last forever, and it is important to recognize that now that the sentiment has gotten so optimistic. We know that Gensler is now stepping down. There should be less regulation on the crypto industry. That's certainly a positive for the entire space. But that's starting to get built in. Every few minutes, I get messages on my watch, all of a sudden that Bitcoin is nearing 100,000 on my smartwatch, and I sense that there are a lot of people that aren't involved that are now sort of scratching their heads and saying, wow, maybe this is something I should consider now that Bitcoin has hit 100,000, and where have I been? There'll be opportunity for sure in the long run. Bitcoin and most of cryptocurrencies remain, one of the better performing assets over the last decade, but these tons of moves, I have three things that I look at. One is cycles, one is counter trend analysis based on works of Tom DeMark, and the other is just pure sentiment. And the three of those are sending a little bit of a warning sign that things have gotten a little bit overbought. With regards to crypto, you don't necessarily sell when it gets overbought. Sometimes that can be a good buying signal. You want to worry when it starts to break down, and it hasn't done that yet. So trends look great, but I sense that as we get towards the end of year, there should be some tax selling that happens in January, and there also, things could start to consolidate just based on the historical cycle for reasons that many people aren't aware of. They could bring buying opportunities for investors likely by the end of the first quarter.
So strength, sounds like strength through perhaps the rest of the year, a little consolidation, and then you'd probably need to stay on that train.
Yeah, I think that crypto, like Bitcoin, for example, I think it probably gets to 111,000. I don't think it has a lot of upside from here, and then I think we'll probably consolidate and potentially give back half of the gains from August of this year.
That would get us where?
Potentially to like 50, 60,000 or so potentially. And just looking at the larger move, I don't know exactly where it bottomed in the fall before it began this recent run, but I sense that a pullback to 60, 65, potentially down to 50, and if that happens within a 3-month window, that would present some very attractive opportunities to buy Bitcoin for a further rally that likely will take us up into next October. So that's my thinking of when potentially a peak would happen next fall. So intermediate term, crypto looks great. We obviously have broken out. The charts look phenomenal on a short-term basis, but I sense that they've come a bit too far too quickly, and people are a little bit too bullish on just the prospects of this deregulation happening that we're going to need to really consolidate before a better opportunity comes for those that like to buy and hold.
And what you say makes so much sense, but I have a very modest part of my portfolio in there, and I take profit, and I can't ever get back in. It was sort of like gold, and I'm an old gold trader, and I'm like, I sell some of my longs, and to take it back on, it doesn't come back, and I'm not long enough, and it's very frustrating. But I will tell you that maybe I should take a little bit of profit here, and because at 65,000, if we get back down there, the market is going to be in despair, and when there's blood in the streets, maybe Warren Buffett will actually deploy some of its massive cash hoard, not in crypto, I would say, but when there's blood in the streets. Just following a little bit more on crypto. Any other any other coins that you follow closely that you think you have a strong view in?
I love Solana. SOL, that's also one that I own personally. I think that's in a similar situation to Bitcoin right now. I mean, it recently just broke back out to new all-time highs. I think it's very constructive technically. I sense that also will come into some consolidation in the first quarter next year. Ethereum has been one that I would really start to watch carefully for investors, because that's been the chronic underperformer. And we saw ever so slight evidence of that starting to change and rally a bit in the last month relative to Bitcoin. So I sense that could be on the verge of potentially having its own breakout year after a number of years of underperformance.
Really? Okay.
So, the technicals now suggest that a sort of a base is forming relatively speaking. So I would warm up to the idea of Ethereum, similar to Bitcoin though. Wait for weakness for those that have maybe under a 6-month time frame, and certainly look to buy dips. And with everything in crypto, I mean, it's good to do things gradually, whether you be selling or buying. One has to be able to stomach the volatility, and it depends on one's own risk tolerance as to how much of a portfolio you want to include in cryptocurrencies. Yeah.
Right. I want to switch gears a little bit and talk a little bit about sort of the philosophy behind technical analysis, if you don't mind. So in my mind, tell me if I'm wrong, but the technical analysis is useful in that it sort of captures the emotion and the thinking and the fears, I guess, of the people who are trading it. Am I right there?
Well, technical analysis allows one to really strip off the blindfold and examine whether trends are higher, lower, or sideways, and it just captures price action along with volume, but one has to include sentiment and seasonality, and there are hundreds of different indicators that one can make use of depending on one's own time frame. So some of us are better suited for day trading, some are better swing traders, some are better long-term investors, and There are technical indicators that work for each of those, but it's always beneficial for investors to make use of something which will help to line up your fundamental idea with something that actually is starting to show good price action and actually participate to be able to reflect those fundamentals. And that's not always the case. I mean, sometimes things can be sideways for a lengthy period of time, and you know, people look at Microsoft and they think, wow, a phenomenal company, and it is, but the stock's gone nowhere since February. And so by using technicals, one can enjoy movement in software companies like Palantir that are showing excellent strength, and just waiting on other stocks while they attempt to break out and really participate. So I find it, you know, a great way to strip out that emotion, to your point, to be able to look at things and you know, really understand why price is moving, and to some extent you come to learn over the years that there's very little that the Fed does or what earnings do, you know, or any sort of economic data that oftentimes help to describe what's happening on a day-to-day basis in the markets. I mean, a lot of it is based on cycles and sentiment. It's less about, you know, earnings that drive stocks on a day-to-day basis, and you know, the more you learn about psychology and sentiment, it just really you know, it helps one to really discover you know, how technicals can really aid one in investing.
Do you approach you know, sort of single name stocks or a commodity a little bit differently than when you're looking at the technicals for something like an index, or there's a lot of names to it? Is there a little sort of a difference that you keep in the back of your mind for the benefit of our viewers who may not?
No, I don't think so. Look, honestly, you know, I was always taught to buy high, sell higher, and sell low, cover lower. I don't like to buy dips. Many of us have tried. You hear, you know, it's human emotion to want to buy low, sell high, but rarely does that work as well in practice. When you try to buy something that is, you know, has been, you know, under a lot of pressure, and you might hope that it's fundamentally worth a lot more, it's just very, very difficult. You almost always want to concentrate on things that are within 5 or 10% of 52-week highs, or even 26-week highs, something that is starting to show good price action. William O'Neill wrote a whole book about this, and he studied over the last 100 years the stocks that went on to make 2, 3, 4, 500%, and they all have one thing in common. They all moved to new all-time highs before that move started. And so investors, you know, often might want to look at things that are starting to show strength, which does bring one into more of a momentum-based strategy. Fortunately for anybody that's invested in markets this past year, that's exactly what's worked for U.S. markets. It doesn't always work, but that has been the #1 style, has been momentum. There will be periods of time when you want to, you know, concentrate on more quality and value. We still seem to be very much in a growth phase. So,
you know, earlier you mentioned the mark. And I've looked at the mark a little bit. I don't know it very well. I know it's like the 9s and the 13s, but you do hear it from time to time. And I don't, you know, I'd like to. Could you explain a little bit about the thinking behind the mark and how useful it, you know, you found it, you know, in your experience, and you know, what are the times to use it, and what are the times that sometimes it doesn't work as well?
You know, look, Tom DeMark is a genius. He certainly has created many indicators after his name. I find it an excellent tool for using counter-trend analysis on existing tools that I already use that are more trend-following in nature. So if a stock is breaking out, one might ordinarily say, well, is this too extended or not? And by the use of DeMark's indicators, one can find things that will give you sells within uptrends and buys within downtrends that most trend-following technicians ordinarily might not even consider. So it's a good confluence to a trend-following portfolio to utilize something that is counter-trend. And so normally, you know, a lot of this is based on the principle of Fibonacci, 8, 13, 21. DeMark actually has, you know, for example, 9 count. If something moves up and you have 9 consecutive closes that are above the close from 4 periods ago, then that will give you your so-called TD sell setup. And then oftentimes you get consolidation, sometimes a reversal. He built on that something that's called the TD countdown, TD standing for Tom DeMark. So when you have 13 closes above the high from 2 bars ago, you complete, and they have to happen consecutively, you get your so-called TD sequential exhaustion counter, or so-called sell signal. So I've learned to use these on many different time frames. I find they're particularly helpful on a relative basis when looking at sectors, when looking at stocks, when looking at indices. it's very wonky type stuff, and so I don't want to bore the listener by any means. But it is something I find very useful to really help to add something to my existing toolkit as a way to approach markets.
Yeah, I appreciate that, because sometimes when I see a tool, I feel a need to understand why it works, and,
right.
and sometimes the time to market is done really, as you say, is done really
right.
well, and there's just really not a lot of free access to the market. I don't think there's any free access to the market actually.
Well, one can buy his books, but that doesn't necessarily tell the whole story. It's really important to watch how those indicators work live. He does have software, it's called Symbolic, that I use. It's a little bit cheaper than Bloomberg. It allows one to make use of that.
That's quite genius, getting himself hooked up to Bloomberg, right? How many people? 325,000 terminals, and
that's right.
Just a fraction of those who buy them. I mean, what a deal!
It's a great business model.
One thing I also want to ask you to explain a little bit in your thinking behind it is Elliot Wave.
Okay.
And Elliot Wave, and I remember when I started in the market, there was someone who was literally an apostle of Elliot Wave.
Right.
But I struggle sometimes a little bit to understand why uptrends move in fives and downtrends in threes. So could you go into a little bit of that for the audience?
Well, it's all based on the principles of phi or Fibonacci, which honestly is one of the building blocks of life. It's found all throughout nature, and they use it to build pyramids. Many of us realize that our own proportions are based on Fibonacci, with 3 parts of the finger, 3, 5, 8. A lot of it is all related based on the principles of, and so uptrends occur in what they call motive waves, or 5 waves higher, and then you have 3-wave corrections. 5 and 3 is 8, and a lot of it is very important to looking at a move to get an understanding of when you see gaps within stock prices, and those can often be wave 3s. It can be very difficult to interpret when you talk to any given Elliotician, and many people have different opinions on what the counts are, but I found a couple services that are better than most. Look, Robert Prechter is a brilliant social scientist. He's been around for a long time, and he took the methods of A.J. Frost and really built a very successful business out of it. And despite his persistently bearish views since 1982, he has really helped to educate the world about how to look at the world from a sort of a social scientist point of view. And for those that are interested, I mean, there's a brilliant book that's called The Wave Principle of Human Social Behavior and the New Science of Socioeconomics that I think was very well done. And half the book is dedicated more towards social science and looking at different eras over time and periods of harmony and depression and really the fact that earnings and the Fed really have very little influence, but what causes these changes in social mood, and many things can be tracked based on Fibonacci, which is also, it will take you down a little rabbit hole that we don't necessarily want to go down. But
sure.
Brilliant indicators, and it's all about using them, in my view, for coming up with projections for stock prices, for risk management, and just to look at the market a little bit differently.
Do you like it a little bit better, sort of long term or shorter term, or it depends on the situation?
Very much shorter term.
Yeah,
I think the recent bounce over the last few days has been very corrective, and is one of the things that leads me to believe that the market could have actually some downside into the early part of December, which might seem like a shock to most investors, just given the bullish seasonality of this year. But the wave structure seems to indicate that the peak that happened on November the 11th likely might have some legs before we can eventually push back higher.
Right. And inescapable these days when we're talking about, we seem to be talking about AI kind of constantly. Do you see AI being used in sort of technical analysis, where potentially you train something to look for the patterns and look for the moves that as one analyst, you can't possibly follow 100 markets that closely? Do you teach an AI to follow some of them for you and alert you when there's something worth looking at?
That's a brilliant idea. Eventually I'll have the knowledge to be able to do that. I mean, right now I haven't used AI nearly to the extent I can. I think that I like to, I don't want to outsource myself, so to speak. I look at the markets very differently, and really, I would love to have something make me more productive in a way to look at markets, but that's challenging. We all have to face the reality that AI is getting stronger and more powerful, and will all be a very big influence in all our lives. We have to also figure out a way to regulate it and rein it in and make sure it's used properly.
Well, it's a tool, and we should all make good use of it. Let's use it and not have it use us.
That's right.
Well, Mark, thank you so much for coming on the show. Look forward to
pleasure.
having a conversation again soon.
Yeah.
Thank you very much.
My pleasure. It's great to be here. Thanks very much.
And that will do it for Global Money Talk, live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thanks so much for joining us. We'll be back again here tomorrow. Have a great day.